A warm welcome to you, my dear children. We meet again with a new lesson, a new session, and a whole new, entirely new practice in accounting, something that you haven't done yet. Bank account and bank reconciliation statement. Have you done bank accounts and bank reconciliation? I don't think so. Bank accounts you have done. Yeah. For those who said, no, we haven't done bank accounts. Think again. Think back. We have done bank accounts. When we learned about the prime books of a business, we learned 6 prime books. Cash book, bank book or the bank account. Then came the purchases book, sales book, and the petty cash book. Journal. Purchases journal, sales journal, general journal. Before you actually learned about the journals, the purchases journal and the sales journal, right, and the general journal, you need to learn about the bank account and something that is related to the bank account in every business, the bank reconciliation statement. Well, in this lesson, children, you are going to learn about the bank account, the preparing of the bank account, recording transactions in the bank account, transactions related to checks, depositing checks, and issuing of checks, withdrawing cash through checks from your current account. So depositing checks, issuing of checks, and dishonored checks, and a lot more. Plus, how the bank account is compared with the bank statement at the end of a month. How the bank account is compared with the bank statement, and how this statement is prepared. This one. What is this? The bank reconciliation statement. All right. So this is the whole idea of this lesson, preparing the bank reconciliation statement. But before that, you're going to learn a lot more about the bank account of a business. Let's go. The breakdown of the subtopics, children. The breakdown of the subtopics. We have bank account. Like I said, recording of cash deposits in the bank account. Recording of checks deposited. Checks. We know about checks. Or we don't know about checks. What's the case? Whatever the case is, we're going to learn how checks how check dealings are done, and depositing of checks in the bank account, how it is recorded. Issuing of checks for payments. Dishonoring checks. New words, right? No problem. You're going to learn a lot in this lesson. Bank ODs, bank overdrafts. All right. Then, as I said, we move down to bank reconciliation statements. Bank reconciliation statements. Something entirely new, whole new thing that you're going to learn. But something that will be important in everyday business. All right, bank reconciliation statement. That is 9.2. Bank statement. Reasons for the difference between the balance of bank statement. reasons for the difference between the balance of bank statement and the bank account. Adjusting the bank account balance, preparing the bank reconciliation statement. All right. So that's that. 9.1, 9.2. Well, there is a lot to learn and a number of subtopics that goes on for a period of time. Not too long, but a little while you should spend on this lesson. All right. A definite question in the examination. Most of the past papers, most of the years, most of the past years, in most of the past years, bank reconciliation statements have come in your paper. Or questions related to bank reconciliation statements in the MCQ paper every year, most of the years, right? So important lesson, no doubt about that. What do we have first? Children, the bank account. Okay, surprised? Of course we are going to learn about the bank account. That's what this lesson is about. It's about the bank account, right? So the bank account, we all know that the bank account is a prime book, right? It's a prime book. Prime book. Some say prime entry book. Some say, most of the time we say prime entry book. Or even if you say prime book, it doesn't matter. Prime entry book or prime book. It's a prime book. At the same time, it's a ledger account. At the same time, it's a ledger account. Yeah, it has debit and credit sides. Debit and credit sides. All right, the bank account. Just like the cash book, children, the bank account has a similar format. What does it say? Most businesses like to conduct cash transactions. Yeah, conveniently and securely by opening a current account. Every business has a current account. Do you agree? Do you agree? Oh no. Well, most of the businesses have current accounts and most of the businesses use current accounts in their day-to-day business operations. Not, if not all, most of the businesses. All right, current accounts are there. Okay, and they use current accounts because there is a special, very special facility that comes with the current accounts. Very special facility. Well, not one, but two special facilities offered by the banks to current account holders. What are these facilities? Well, to start with, I'll just make it short. Children, current accounts, bank current accounts offer the facility of checks. The ability to conduct check transactions, to do check transactions, to use checks. All right. And the second facility is overdraft facility. To use ODs, overdrafts. Overdrafts. These facilities are offered by the banks to every current account holder, to every business which has a current account with the bank. Bank gives these two facilities. It's very, very convenient when you have a current account, when you can deal with checks and when you can obtain overdrafts. You're going to learn about these things later. All right. So the business can conduct transactions conveniently and securely by opening a current account. All right. The bank account and the cash book are considered as asset accounts. Both are asset accounts. What accounts? Cash book and the bank account. Both are asset accounts. I told you that both are very similar. Considered as asset accounts. All right. Therefore, when the asset accounts. Therefore, when the transactions are carried out through the bank account, they should be recorded according to the double entry principle for assets. Like I just few minutes before, just like I mentioned, cash book and the bank account, both of them plays the dual role. Okay, both of them are prime books and at the same time ledger accounts. Okay, so when the transactions are carried out through the bank account, they should be recorded according to the double entry principle. According to the double entry principle in the bank account when you record the transactions. All right, moving on. Deposit of cash in the bank. Well, cash taken from the cash register, brought to the or taken to the bank and deposited in the bank. Simple transaction. Yeah. Cash which is in the cash register or which is in the business, taken from the cash register, deposited in the bank account. Cash decreases, so cash book credit. Bank account balance increases, in the bank account debit. That is the double entry. Bank debit, cash credit. That's what it says. Depositing of cash in the bank. A specified amount of cash has to be deposited to open a current account. We know that. In addition, cash received by the business would be deposited in the current account. Cash received by the business would be deposited in the current account. That means the cash which you get in the business, you go and deposit in the account. Sali bank දානවා කියන්නේ. That's why. That's what they say. Hey, we have to be mindful about the local situation, right? The local context. The businessman say, bank sali දානවා. That's what this means. Take the cash, deposit in the account. Deposit the cash into the bank. The balance in the current account increases and the cash balance decreases. The double entry is this. Bank account debit, cash book credit. Just like I said. The double entry for depositing cash, business cash in the bank account. All right. All right. What's down underneath? When depositing cash, a deposit slip has to be completed and submitted along with the cash to the bank. Children, what it says simply is, when you go to the bank with an amount of cash, you just don't go to the bank counter and throw the money at the cashier. You can't do that. You can't just go to the counter and hand over the money. You have to fill a bank deposit slip, cash deposit slip. Okay, cash deposit slip. Have you seen when you enter the bank, any branch, any bank, when you enter, right in front of the cashier or the cash counters, or just when you step in to a bank, there's a small table, a small flat table with a pen attached to the table. On the table, there's a pen attached, right? And on that table, there are multicolored slips, paper slips, printed papers, light yellow, light pink, light green, light blue. Those are slips, bank slips. Out of those slips, you should choose a cash deposit slip. Most of the time, it is the light blue slip, as I can remember. But from bank to bank, the color differs. Okay. Most of the the bank that I deal with, in that bank, let's say commercial bank, let's say Bank of Ceylon. In that bank, there is a light blue slip for cash deposits. That's why here it says, when you deposit cash, first you should fill the slip. Take the slip, fill the slip, mention your amount that you are going to deposit, mention your name, the account number, sign it, and hand over the cash with the slip. That's what it says. The bank returns a duplicate of the slip to the customer or the depositor. So this slip, the cash deposit slip, acts as a source document for the business. It acts as a source document for the business, which means you take the cash deposit slip to your business and you file it. Right. Source document for the recording of the transactions. There we have a cash deposit slip. Do we have a cash deposit slip? Yeah. No, it's a check deposit slip. Yeah. This is a check deposit slip, but most of the time, children, in most banks that I have seen, for the check deposits and for the cash deposits, the same slip is used. Okay. That's why here it says check or cash deposit slip. Cash or check deposit slip. All right. Here, children, we have actually here we have some areas or some blanks to fill, and this in this sample, children, there is a bank copy and a customer copy separately on either side, on the left side and on the right side, the bank copy and the customer copy. But in Sri Lanka, in our country, in practical day-to-day real life, there are no two sides as bank copy and as customer copy, right? There are no sides, two sides separated. The same slip has a copy or a duplicate slip underneath, right? Which means every slip has two layers. Every slip has two layers. So this is the top. On top, the slip is there, and underneath there's another copy of it. That is called a cash or check deposit slip. Okay, we have to fill it when we deposit our cash in the bank. Let's fill it. Let's be quick about it. Account number 0013508353. You have to fill the account number on the slip. Then you have to fill the account holder's name, that is my name, the person who has the account, owner of the account. Account holder's name, let's fill it with my name, Prabhat Ranasinghe. Mention the date. Right. Then the denominations, or how many notes and coins you are going to deposit. How many 1,000 notes? How many 500 notes? How many 100 notes? Likewise. Then put the amount in rupees, right? And total you mention at the bottom. Sign it. Right? And hand over to the bank with the money, with the cash. Then to this account, the cash will be deposited. Cash will be deposited to this account. That is my account. All right. That is how you deposit cash into the bank. So cash goes out from the business till, which is the business cash register. Cash at hand, cash decreases, which means cash account should be credit. Yeah. The bank account should be debit, because money comes into the bank from the business cash. This is a cash or check deposit slip, which you can obtain from any bank, and fill it before you deposit the cash in the account. Double entry, we already discussed the double entry: bank account debit, cash account credit. Right. Deposit of checks received by the business. Now children, same double entry is given, but the same double entry. All right. Bank debit, cash credit. Same double entry is given: bank debit, cash credit. But this is not depositing of cash. It is depositing of checks. It's the same thing. When a check is received, customers hand over money sometimes, or they could hand over checks to us. In other words, children, when they pay us, they could pay us in cash, or they could pay us by checks. Both should be accepted. You can't say no. You can't say, no checks. We don't accept checks. Cash, please, cash. Bring the money. You can't say that. You can't say that. You have to accept checks. When you accept checks, you take the check, put it in the cash drawer or the cash register. Keep the check in your cash at hand, which means your cash at hand increases. Cash at hand increases. Okay. You don't, at the same time, at the very moment you get the check, you don't run to the bank with the check. It's absurd. It's ridiculous, right? When a customer comes in with a check and he says, "Mudalari, me check එකක් දෙන්න. මම ගෙවන්න ඕනේ ගාන මම check එකකින් දෙන්න." And you say, checks. Right, okay. You wait for half an hour. I'll run to the bank with the check. No, you can't do that. You have to get the check, keep it in your cash till, in the cash drawer or in the cash register or in the large drawer, in the drawer. Okay, whatever it is, wherever you keep your cash, you keep your checks. Which means, children, the checks received are debited to the cash book first. Okay. Then, when you take the checks out of the cash till, or when you take the checks out of the cash drawer, that money decreases. That is why again the cash book is credited. And because the check is going to the bank account, bank balance increases. That's why bank account is credited. Got it? Yeah, that's what. So it says the same thing here. Balance in the bank account of the business will increase when checks are deposited. As explained earlier, when checks from debtors and cashiers are received, they are first debited to the cash book. Same thing as I just now explained. I just now said the same thing, right? First debited to the cash book. All right. So children, cash deposits and checks which you had in your cash till, those check deposits has the same double entry. Okay, that's what you should realize. Yep, some more explanation here, some more details. However, if the received checks are deposited to the bank at the same time, deposited in the bank at the time of receipt, instead of debiting to the cash book, they are directly debited to the bank account. That is something else now. It's like this, children. Just like I explained earlier. When a customer comes in with a check, you have to accept the check. Okay? You have to accept the check. Just like you accept money, you have to accept the checks. So when a customer comes and tells you, Ali, Ghana check, you say, okay, right? Okay, you pay me with a check. And when you accept the check, you don't say, wait for half an hour. I'll go to the bank and I will this check to my account and come back. Okay, then you don't run to the bank. But you can do this. You don't accept the check and you don't put it to the till. You don't accept the check and you don't keep the check in your cash till. You say, bank. You take the check and deposit the check in my account. Bank check. You don't accept it. You don't take the check and keep it in your cash till. That means your cash book is not gonna be debited. Directly, you tell the customer to deposit the check in the bank. In that case, children, this happens. Cash is not debited. Bank account is directly debited because the check doesn't come to your cash till, it goes to the bank. So bank money increases directly. You get it? Right. The check received from the sale amounting to 10,000. A check received from cash from a sale amounting to 10,000 was deposited to the bank account immediately. In that case, this is the double entry. This is the double entry. So that's how it happens. Double entry should be remembered, children. There is no other way. You should remember the double entries, or you should remember the double entry principle and guess the double entry right. Guess it right at the first time. Just need to think what increases and what decreases. Bank money increases. Bank money increases because a check is going to the bank. So bank money increases. Bank balance increases bank debit. Sales income increases at the same time because it's a check received from a sale. Asset increases debit, income increases credit. Debit, credit. Okay. Right. When received checks are deposited, a check deposit slip should be completed. Same thing, check deposit slip. Yeah. And submitted to the bank along with the checks. A duplicate of the deposit slip is given to the business or depositor by the bank. This document is used as a source document. Same scenario as a source document when the transactions are recorded in the books of accounts. Okay, that's it. So children, next day we are going to talk about issuing of checks. We now discussed briefly how check deposits happen, in which instances, in what situations, and how cash deposits happen, in which instances, in which situations, plus the double entries which should be recorded in cash deposits and in check deposits. Further, when checks are directly sent to the bank, double entry is different. Remember all these things, remember them clearly. Next, in the next session, children, we are going to talk about issuing of checks, and recording issued checks and dishonored checks, and a lot more. With this, we wrap up today's session. We are going to talk about a lot more going through bank accounts and recording of transactions in bank accounts, plus bank statements, the balances of bank statements, and business bank accounts. Children, as I told you, it's an important lesson. It's a lesson which always comes. Questions are given in your paper, in your O-level paper. So I hope that you will continue and you will watch the upcoming sessions. Hoping to see you soon. Thank you very much.